Good day, everyone. I hope you're all fine. I think this will be our last lecture video on management accounting, right? So the next videos that will follow or that might follow will be more of solving questions, right? Because you are preparing for the exams. All right. So let's proceed. As you guys know already, Nehemiah here, and then today we'll be diving into our final lecture session under management accounting. So let me share the screen. Uh, all right, so this session is actually covers specialized management accounting methods. So we have different kind of management accounting methods. Some of the methods includes um, activity-based management costing. Some also have target costing. Some also have life cycle costing, and then you also have throughput costing, and then environmental management accounting, right? So we are going to talk about these kind of methods in this session. All right, so our objectives for today is that we should be able to explain cost management and describe how activity-based management is used to manage costs. We should also be able to describe the life cycle costing and explain how it is used to determine product cost. We should also explain target costing and use it to determine the cost of a product or a service. We should be also able to explain the theory of constraints and explain its application in throughput accounting, right? So throughput accounting basically is more or less like what we did in relevant costing, which was more or less like the limiting factor. But here we assume that only material costing or material cost or materials is variable, right? So we are going to dive more into this. And then at the later session or later part of this session, we should be able to discuss environmental management accounting and the rules of environmental cost accounting for sustainability. You know, today's world, nothing goes away. Like we can't actually preach anything without chipping in sustainability. Yes, so that's why this particular part or this particular session will cover environmental cost accounting and then for sustainability as well. All right, so our learning objective one, which is more like we should be able to explain cost management and describe how activity-based management is used to manage cost. As we know, for the old traditional management accounting costing system that we did in like cost accounting one or cost and management accounting one, we were actually more of um, focus on comparing results against a preset standard, right? And then it was more of identifying, analyzing variances and taking remedial action to ensure that the future outcomes conform with the budgeted outcome. So here, there's an emphasis on cost containment rather than cost reduction. So we wanted to make sure that our cost is being contained, right, rather than we reducing the cost. So strategic cost management is a future-oriented approach that focuses on cost reduction and continuous improvement and change rather than cost containment, right? We want to make sure that we reduce cost in the future, right? So cost management is actually the improvement of organizations' cost effectiveness. So more or less like we finding ways and means to reduce the organization's cost. And it consists of those actions that are taken by managers to reduce cost, but can be used to improve other aspects of performance. So some can be we actually improving the quality, but actually maintaining the cost, or maintaining quality and reducing the cost, right? And it can also be delivery, value creation, customer satisfaction, that kind, right? So it entails cost control and then cost reduction. So Reducing cost is very important because it enables a company to remain competitive, right? If you have if you have the lowest cost in the industry, what it means is that you'll be in the industry for a very long time. Right? Although cost management seeks to reduce cost, it should not be at the expense of the functionality or customer satisfaction. So what this basically means is that even though we want to reduce cost, it shouldn't actually reduce the quality, right, of our product or how the product should function, right? And it shouldn't also reduce the customer satisfaction as well. So this is what this is actually the difference between the traditional cost management and then the strategic cost management. So on the focus side, the traditional cost management focuses on what internal operations and cost control, whilst the strategic one focuses on external environment, competitive advantage, and then value creation. So it's more future oriented, and then it's more or less like a long term, right? So for the perspective, this is a short term, and then it's what cost minimization, and then here is what long term strategic alignment with business goals. So for the approach, we can say that cost control relies heavily on accounting techniques. Whilst here, though some may use accounting techniques, others are undertaken without the use of accounting information. So the tools that is being used under the traditional cost management is standard costing, variance analysis, and budgeting. Whilst for the strategic cost management, we use value chain analysis, we use target costing, benchmarking, life cycle costing. We are going to discuss them very soon. Then on the application, they are routinely applied on a continuous basis. But here we apply them on ad hoc basis when opportunities for cost reduction are identified. So we only use it when we actually want to use it. So the first cost management system here we are having is activity-based management system. So what the activity-based management system does is that it actually highlights the part of a business that is making losses, and then it finds ways and means to improve it, right? So remember the activity-based costing where it is shared according to how departments, the costs are actually shared based on how departments are actually involved in the production, right? So for the activity-based management, it uses principles of activity-based costing to improve organization's activity, right? And then improve its efficiency. So at this point or in this kind of strategy, decision making and profitability is actually enhanced, right? And then it focuses on activities to enhance value for customers and also eliminate waste, right? So they find their possible best to make sure that waste is being reduced in the organization. So these are some of it. I've just tried to summarize whatever is here, right? So when you get a slide, you can actually go through it. So the activity-based management for cost reduction. First, it's what identify the major opportunities for cost reduction, and then it determines the real causes of the non-value added cost. Now, what it is going to do is that it will develop a program to reduce that particular cost that it has identified or has seen. Then it will actually measure the performance in cost reduction. Now, now, our next part here is to describe or to move to life cycle costing. And for the life cycle costing, it's more interesting in the sense that it look at the cost of the product from the time of planning to when it will end, right? So here, if you're able to do this well, you can actually do what? Use target costing, because you find the prices in the industry. For target costing, what they do is that they find the prices in the industry through research. Then what will happen is that they actually make sure that their cost is less than that particular price so that they can what make some profit on it. So we are going to talk more about this in a jiffy. Okay, so life cycle costing. So for the life cycle costing, it's an approach, right, that we actually use to track and then accumulate cost and revenue attributed to a product over its entire life, right? So what happens here is that we take the product and then estimate its entire life, how long it is going to take, and then we do what? We estimate its uh, total cost, right? And then find the life cycle cost per unit. So what it means is that if the product is having like 3 years, what's going to happen is that we find the cost in year one, cost in year two, and then cost in year three. Then we add all of them, right? Then now we divide by the number of units we are going to produce. So the life cycle cost per unit is going to be equal to the total cost of the product in its entire life. In its entire life, all over the total units of. So the total cost that they are going to bear for the product from its entire life over the total unit that they are going to produce, and that's going to give us the total cost per unit, the life cycle cost per unit of that particular product. So this life cycle we are talking about is the life cycle we already know in our previous session. So now we have we normally have right to be this way, and then we have Now, when it comes to the product life cycle, it is actually divided into one, we have the development stage. Two, we have the introduction stage. Three, we have the maturity stage. Four, we have the growth stage. And then five, we have the decline stage. Right. So this is the life cycle of it. So now this becomes our revenue curve. Revenue curve. Yeah. Then this one becomes a profit curve. Right. So now here becomes the what? The development stage. Right. At the development stage, this is where the product is about to be developed. And here we've not sold anything, but we are incurring losses because here planning comes in, some consultations comes in, some market research and analysis comes in. Right. So here there is no revenue. Revenue is zero, but you can see that profit is what? Negative. Profit is negative. Here is negative. The profit becomes negative here, right? At the development stage. So at the development stage, we are actually incurring only cost and no profit, right? Now, here becomes the introduction stage. And now for the introduction stage, this is where the product is now being introduced into the market, right? And there is less awareness, right? So what we are going to do here is that we are going to do more advertisement for the product to be able to be popular, or people so that people will be aware of the product. So here as well, we'll be incurring more loss because more in advertisement, and then revenue will not be that much, right? So still profit line will be still in negative. Now we have the growth stage. The growth stage is more or less like a point where profit is actually increasing. Profit is now coming small, small, right? Profit is coming small, small. And then there's more or less like the demand of the product is also what's increasing. So you can see that here at the growth stage, revenue is actually increasing as well, right? Revenue is increasing as well. So we have to also put that in our mind that revenue is increasing at this stage as well. And that is one of the product life cycle. So now the next one we are going to talk about here is the maturity stage. Right? And here is the the point where sales is fairly constant and demand has almost gotten to its maximum as well. So demand is actually constant. Here, if you want to make any analysis, it becomes a bit accurate as compared to where the market was was uncertain, right? So here, the profit is actually a bit high. Then the sales is also fairly constant and demand is also fairly constant. Now we have the decline stage, which is here, right? So here's the decline stage. The decline stage is where it's a product not for, and then what the demand is actually falling, and then sales is actually falling as well. Or it's the declining stage can be can be a stage where there is like a new technology, right? Which is actually or a new product which is actually performing like the old product but performing it maybe better. So let's say in a case of a TV, right? A TV will go through this stage, and at the declining stage, maybe initially it used to be 80 copper, and then now we are having what flash screen and the likes, right? So it's all parts. You can also associate your relationship with this, right? At the talking stage, you could see that one person will be making what will be putting more effort. One person will be talking plenty. So at that side, the person talking plenty will be facing an expense because here the reply to him or her will be what a bit low, right? And the likes. Now, when in the introduction stage, it's continuous like that, where now I think say the vibe is actually a bit like the vibe is now flowing some more, some more. So now, maybe in the case of the lady is able to reply fast a bit, right? Now, when you get to the introduction stage, in the growth stage, sorry. Now you guys have known each other and you've started your 1 or 2, 1 or 2, 1 or 2B. You have, Now the maturity stage will be the stage where both of you guys are like happy together and the likes. Now the declining stage will come in when the guy has gone to see a nice girl somewhere with some body curvy and the likes. Now he's trying to decline the lady. Or the lady too has gone to see some rich guy somewhere, right? Who is actually doing her good. Now it starts to decline the relationship. But here we are trying to say that the life cycle cost, right? The life cycle costing will actually involve the cost that will be at the development stage, at the introduction stage, at the growth stage, at the maturity stage, and at the decline stage, all added together. You get it? So here, in some questions, we can even get time value of money. We have to apply time value of money, right? So here, the cost that will be incurred in all these stages combined together is what will be we are terming as the life cycle cost. Do you get it? All right, I'm sure you get it. Now, all right. So this is actually the summary of whatever we are having here, and I've explained them. So you can, when you get a slide, you can go through it and then get more understanding. So we have the pre-production planning, design phase, and the ongoing manufacturing. You let me read the slide for you as well so that you get it. So now the product is the time from the conception of a product through to its abandonment, right? So you meet a lady and then you ignore the talking stage as part of the number of the number of years you guys started moving together. No, the time you took her number, no, and then you had that mindset. So no, this girl, dear, I for run them. That's the starting stage of the distance. You get it? So product planning and the initial concept design through product design, through product design and development, through production and to distribution and customer support, right? So it's from that side to that side. So sales life cycle also include the introduction phase, growth phase, maturity, and then decline phase, right? So yeah, you should have okay, maybe our syllabus is not having the development one as well. So now We come to the life cycle costing. So life cycle cost, estimate the accumulated cost over a product over its entire cycle. So that's what I said. To determine whether there will be profit and during the manufacturing phase can cover costs incurred the pre and post manufacturing stage at the pre and post manufacturing stages, right? So we want to accumulate the cost and see whether our profits can or our revenue can cover them, right? Or we can make profit. So we identify the cost incurred during the different stages of the product life cycle. The product life cycle could provide an insight into understanding managing the total cost incurred throughout its lifespan. So we have two important aspects. We actually focus on the product cost, and then also we include all upstream costs, any cost that will come in research and development in engineering. Downstream costs will also include marketing and distribution service, right? So basically, the life cycle that we said there are 5, we can actually group them into 3, right? So for the 3 is the stages. So it includes a pre-production planning and design. Then we also have the ongoing manufacturing phase, and then we have the post-sales and abandonment, right? So the life cycle cost management helps management to understand the cost consequence of developing and making a product, and to identify areas in which cost reduction efforts are likely most effective, where we can actually reduce costs. So in life cycle costing, approximately 80% of a product's costs are committed during the planning and design stage, right? So that's where we are trying to say that target costing and Kasano, it actually deals with it actually starts from the planning and development stage, where you're actually going to look for prices and then try and then find the average, and then make sure that you are able to attain that price, but you are also going to make profits, right? So you find the costs. So meaning that what you see in the normal markup thing that we will do, that we will do cost and then come and add profit before we bring selling price. Here you start from selling price and then you reverse it backwards when we are doing target costing. So we are going to do that very soon. So you can that's what I've explained so far, so good. So we can take this sharp quick question. This is PR question. So here you are saying that a company is planning a new product. Market research suggests that the demand for the product would last for 5 years at a selling price of 10.5 per unit. They expect to sell 2,000 units in the first year, 12,000 units in each of the other 4 years. The company wishes to achieve a markup of 50% on the life cycle cost. It is estimated that the life cycle cost of the product will be as follows. Have the manufacturing cost to be 6 Ghana cedis per unit, the design and development cost to be 60,000, and then the end of life cost to be what, 30,000. So here they say we should calculate the life cycle cost and expected selling price per unit of the product, right? So let's do the do. Now, because we are seeing something here as the per unit, you said they told us that let's first calculate the total unit. So now let's start with the manufacturing, the units that they are going to actually sell. So units, or let's say total units. Now, the question was like, or they plan to what? Sell 2,000 units in the first year and 12,000 units in each of the other ones, right? So the other 4 years. And with this, 12 for 48, 48 plus 2,000 will be 50,000. 50,000 units. Now, in this 50,000 units, we have a manufacturing cost there, and we also have design and development, and then we have end of life, right? So now, let's do this. So what we can do now is to find cost. You have manufacturing cost. So the manufacturing cost here, we are having 6 per unit, so 6 times. And we are going to get 300. And then we also have design and development. Design and development. Mind you that if you've not liked this video, kindly like it for me, and I'll be sharing the document. I'm sure everyone is already having it, but I will still share it on a Telegram channel. Here, it was 60,000. Okay, I'm fine. You have end of life cost. End of life cost is going to be 30,000. So now our total destiny is going to be, total life cycle cost is going to be 390,000. Right? This is the money that you'll be spending, you are going to spend on the lady. Right? Hey, this is the money that you are going to spend on the products. Now we can mark up our 50% because they said they make a markup of 50%. So mark up 50%, 0.5 times 390,000. And it is equivalent to 390 divided by 2. So 390,000 divided by 2, 195,000. And this will be our revenue. Revenue 585,000. Right. So this will be our revenue. But the question told us to solve for the life cycle cost per unit, and then the revenue per unit as well, right? Or they didn't say that. So you calculate the life cycle cost per unit, and then the estimated, the expected what? Selling price per unit. Okay. So life cycle cost per unit. It's what we said. We say is that the total life cycle cost over the number of units to be produced. That's what we said up there, right? So in this question, the total cost was what? 390,000. Then we plan to produce what? 50,000. So we are going to get 7.8 per unit. And I see the per unit. And then the expected selling price. Expected selling price is going to be what? It's going to be the total revenue that we have 585,000 divided by 50,000. And we are going to get 11.7 per unit. Right. So this is it for this question. I'm sure you understand. If you don't understand, you can drop a comment and then remove. All right, so let's move to the next specialized accounting, management accounting method. So the next one we are coming to talk about here is target costing, right? And we've been able to establish that for target costing, we are actually going to look for, or we have a predetermined cost for a particular product, and we want to make sure that we are aligning our product into that cost. So what we do here is that target costing involves setting a target cost by subtracting a desired profit margin from a competitive market price. So I told you that for marginal costing, for target costing, what happens here is that we have the market price already. Oh, why is the pen messing up again? Right. That's what we are going to look out for. We look out for the market price. Then now, our expected margin that we normally make is what we are going to. Okay, so we less margin. And then we get our target cost. And this actually happens when eh, you've been given only market price, and then they've given you what? The profit margin for you to backward it, right? So for the target costing, there is more or less like a research already in the market. They will go and do their research, and then they will ensure that they get the expected cost for it, and then they make sure that they produce either less than that particular target cost, or they produce exactly that particular target cost, right? So they want to get the same kind of cost when it comes to that. So here what they actually do, so there are some steps that are involved in here. So what they are going to do here, the first step is to what? They specify the product features and price. Then the next one here is that they are going to determine the target selling price based on the market research. Now, okay, let me go into the slide. So these are the steps. They specify the product features and price. They determine the target selling price on the market research, right? So they will do research about the price and then they are going to associate it to what they want to produce. Now they will determine their desired profit, whether they want to make 50%, 100%, 200%, or whatever profit, right? And then they are going to subtract it from the price that they have to come and then reach their cost. So they compute the target cost to achieve the desired profit, and then they design and produce the product to meet the target cost, right? It's either they are producing to meet either lesser than the target cost or exactly to the target cost, and they don't want to go over it. So here, cost reduction objective is the target cost gap, right? So when we say target cost gap, we mean that the target cost that they will get, the cost that they will get from like the difference between that one and then the actual cost that they will get when they produce the product. So um, let's say they produce the product and then the cost is 12 and then their target cost was like, let's say 10, and the difference becomes for the target cost gap, and if it is the other way around too as well. So here, the major advantage of adopting target costing is that it is deployed during the product design and planning stage. That's why I said in the previous life cycle this thing that the target costing comes in at the development stage where the distance as infants. Until before you see the girl pen, you should have your costs. You should target the cost, that the amount of money that you are going to spend on this lady. Otherwise, we boka. All right. Sorry, my bad. It is an iterative process with the design team, which ideally should result in design team continuing with the product and the process. So here, this slide is Lankasa, you can read and then get more understanding. But the basic is what I've given out, right? So let's look at this example here. So Kama Pharmaceutical is about to launch a new drug, and they expect the drug to generate a 30% pre-tax return on investments per annum. The property, plant, and equipment needed for production of the drug will cost 5 million, and it's expected that 40 packs or 40,000 packs of the drug will be sold annually, right? They are going to sell 40,000 packs annually at a selling price of what they've given you. The selling price, this is what they did the research. They had this selling price of 67.5 per packet. And they said we should determine the target cost of the drug per packet, right? So meaning that whatever price you are going to get, we divide it by the number of packets. All right. So let's go to our whiteboard. Now with this one, they are having their price, the price that they went on the market, target cost. So the price was what? 67.5. Right. Now, they've given us a fixed cost here already. So let's bring in that fixed cost and then look at something. So cost per unit of the fixed cost. let me put it here. And then they said it was what, 5 million. Right. Now, since you want to deal with the distance per unit, let's divide it by the number of units that they are going to produce. And then get our fixed cost per unit. So they say they are going to produce 40,000. They are going to get 1, 2, 5. Right. Now, since they are striking to get what? A margin profit of what? 30%. So let's get that done here. So their margin, %30. Right. So we are going to multiply that 30% by 1, 2, 5, which is their destiny, and then we are going to get right. So now we are going to subtract it from this one, and then we get 30. So the target cost per this thing is 30. Right. So you see the target costing is a bit straightforward here because in the slides, the questions are easy. So we are going to solve more questions after the video to embrace our software. So this is more or less like the basic testing of the target costing, right? So let me write this one. Right, so the price from the margin, and then we get target cost per packet. You can do it the other way around by getting the totals and then divide it by the number of packet. That one too is fine. But this is, I think, the easiest one for me. All right, so let's move to the next one, which is the throughput accounting. Throughput accounting is not difficult, but it's a bit tricky. As I said, it's more or less like the limiting factor. So this is it. So this it's like the limiting factor now. So for the throughput accounting in the interior of constraint, what happens is that here, you see, in what we have been doing so far, we normally assume that we have labor cost to be variable, material cost to be variable, and then other variable overheads. But under throughput, what we are seeing to be variable is the material. So for throughput there, we only think that material cost is what the only variable this thing that we have. So now, with that one, we have to make some assumption, right? So we have to make some assumptions, and then so with this one, we are going to actually do some 102, 102, 102B. So let me see what I have. So the throughput accounting is more or less the limiting factor, and then sorry for the networking. Pay him thing for this one. All right. So for the throughput, as I said earlier, we actually think or we assume that uh the only variable cost that you'll be having is material, and the other ones are all factory costs. So here it is also under the theory of constraint. Rates identify and remove bottlenecks to improve throughput rate, right? So it considers the management of bottlenecks, which is more sorry, this network is just messing up. All right. So it measures the effect of bottlenecks and operational decisions using financial measures of throughput, investment, and operating expense. So when we talk about throughput is basically the revenue minus the material cost. So here they are saying that the true variable cost is direct material, right? So that's what we are going to look at most often under throughput. So when it comes to investment, the resource that the business has tied up. You feel for, I don't like what you guys are doing, right? And then when it comes to investment, the resource that the business has tied up in inventory, building, machinery, and other assets. So we also have our operating expense, which measures the cost of converting inventory into output, such as the cost of labor, machine maintenance, and utilities, right? We are going to delve more into this. Now, for dealing with throughput, there are some assumptions we have to make, right? So these are the assumptions. So we have to assume that in the short term, all costs in the factory are likely to be fixed except material cost, right? That's what we assume. That's the assumption we have for throughput. And then also in a just-in-time environment, organizations should attempt to eliminate inventories and any work in progress. And any work in progress should be valued at only the material cost, right? So we don't use the variable cost, the total variable cost. We only consider material cost to be the true variable cost. And so there are some these things that we are going to use here. So the throughput accounting ratio is very important in the sense that it will let us know the profitable products and the non-profitable products, right? So we are going to do that very soon. So when you solve for the throughput accounting ratio and it's greater than 1, then it means it is profitable. But when it is less than 1, then it means it is not profitable, right? So I don't think that one is in the slides though, but we will be talking about that. So let's talk about this. All right. So for us to actually solve a throughput accounting question, we need to identify or we need to know some 1 or 2 steps. So we have some steps here. So first, we have to identify the system constraint. And then we have to decide how to exploit the system constraint. We have to also make sure that everything else is in the decision that is up there in the step 2, right? But that is just the normal one. Now, if you see a throughput question and you really want to solve it, now this is the first step I would want you to take. So there are the steps. Oh, sorry, my network has been messing. I don't know why I ended there. Let me see my pine. I'm saying to me, Oh. All right. So steps in solving some of the questions. So the first thing for you to do is to calculate the throughput per unit. And the throughput per unit is equal to the selling price minus material cost. So selling price per unit minus material cost per unit, right? Minus material cost per unit. And that's what you are going to use to determine your throughput per unit. Now, you calculate the throughput per machine hour. Right? And we are going to do that one soon. And the third one is to rank the products. So when you solve for the throughput per machine hour, so first when you get the throughput, then now you divide the throughput divided by the hours that is being required by each product, right? So the one that will be having the highest throughput per machine hour will be ranked first, and then now the next one is to what? Allocate the resources. And then continue like that. So when you allocate the resources, then you produce them, right? So let's take a question now, and then deal with it. So here's a question we have in a slide. So it says that the cost card for two products of Unilever Limited. No, wait. Let's deal with this formulas. Now, there are some formulas you would want to keep in mind. So as I said earlier, the throughput, if it this you talk about throughput is equal to what? Selling price minus material cost. You get it? And that is the throughput. Now, the next this thing for us to actually keep in mind here is the return per factory hour, right? So And this is actually computed by the throughput that you computed up there. Throughput per unit divided by hours of key resource or bottleneck resource, any of them, key resource used per unit. All right. Now, the third one is that, and this was actually funny in the sense that during the TBSC challenge, the tertiary business test challenge, they were asking this question. I was like, hey, then I'm on you know. Hey, they really have to learn ahead, though. All right. So the next one here is the cost per factory hour. Cost per factory hour. So the cost per factory hour is actually what the total factory cost all over total key resource available. Available. Right. Now, the total factory cost here under throughput is going to be the other cost, the labor cost, the overhead, and the fixed cost. And that's what is going to entail the factory cost. So I think, okay, let me say I've said it. So now the fourth one, I wish I put something up here. Okay. Let me put it here. It's going to be labor cost plus overhead. So overhead could include either fixed overhead or a plus variable overhead, sorry. Right. And the fifth one is the Bosunankasa. The reason why we are here in this session is a throughput accounting ratio. Right. So for the throughput accounting ratio, what is just going to happen is what you've calculated up here, this over this, right? Meaning that what, or where is it? Yeah, 2 over 3. So 2 divided by 3, right? And that is what you are going to get as the throughput ratio. The throughput ratio is going to be equal to the return per factory hour all over the cost per factory hour. And that is the throughput accounting ratio. Now, when you get the ratio to be less than 1, means the product is profitable. And when it is less than 1, it means it is not profitable. So you have to find ways and means to use it. So now let's go through the question. So the cost card for 2 products of Unilever Ghana Limited, Geisha and Key Soap are presented. If the total hours available are 48,000 hours, calculate the optimum production plan and maximum profit using the throughput accounting approach. And also, we should calculate the throughput accounting ratio for each product. All right. So we have the Geisha figures here. We have the Key Soap figures here. All right. So let's start. So now, remember what I said, the formula, the steps are, you want to solve throughput accounting. First, you calculate what the throughput per unit. Now, let me write Asia here. Let's calculate the throughput. So now, let's do it for Geisha. Kiso. So we have the selling price for Geisha is 25, and then for Key Soap is 28. Now, find the material, which is the true variable cost we have under throughput. And that's 8, and then 20. Now, our throughput is going to be re-subtracting them, right? So less. And then here we'll be getting 17. And then here we'll be getting 8. And here's our throughput per unit. Right, this is going to be our throughput per unit. Now, since we have our throughput per unit, let's move on to calculating the next thing. What was the next thing? The next step is to calculate throughput per machine hour or per labor hour. Any of them is the same, right? Any of them are a rough one. I already said time. So step 2. All right. So now let's bring the labor hours. So now in the question, they said that we need 2 labor hours. We have 2 labor hours to produce 1 unit for geisha, and then 1 labor hour to produce a unit of key soap. So we have then 1. Now what's going to happen here is that let's name here A and then B. Right. So our throughput per labor is going to be A divided by B, right? So what it means is that our throughput we computed up there divided by uh, the labor hours you're having down here. So for geisha, it's going to be 17 divided by 2 is giving us is giving us 8.5. And then for this one is going to be 8 divided by 1, which is giving us what? 8. You get it? So the throughput per unit divided by the labor hour per unit, and this is what we are getting here. Now, the next step is for us to what? Rank them. Now, we rank them based on which one is big. Now, you can see that Geisha's own is big, right? So we rank this one first. We are going to produce Geisha first, then produce Key Soap what? Second. All right. Now, our next step is now to what? To produce them, right? Now, let's produce them. Now, if we are to produce them, you can see that in the question, they said the machine, the maximum demand for what geisha is 20,000 units, right? So 20,000 units is what we are going to produce for a geisha. So geisha, we are going to produce remember it's what has it uses 2 hours per distance, so times 2 is going to give us what 40,000 hours. Now, since the total hours available is 48, it means that if you are using 40,000 here, to be left with 8,000 hours. So 8,000 hours to be left for key soap. Will be equal to what? 48,000 minus 40,000. And we are going to get, so now what is going to happen? What's going to happen is that for Geisha, we are going to produce 40,000. And for key soap, you are going to produce 8,000. Hey, time, Kosa. All right. So now you have to compute for the profit and the lesson that they are talking about. So now let's compute for the factory costs. Factory costs, we have geisha, we have key soap as well again now. Now, remember the factory overhead, as I said, is what? It comprises all the distance. So here we are going to have the labor, which is 5 for this one, plus 7 plus 3, which is what? Equal to 15. For this one, it's going to be 2 plus 2 plus 2. It's going to be 6. Right? This plus this plus this. And here's this plus this plus this. So now, if this is the factory cost per unit. Now, when we multiply it by the number of units we are going to produce, let's multiply by the number of units we are going to produce. Total factory cost now. Total factory cost for geisha is going to be 15 times we are going to produce 20,000 units. And we are going to incur what? $30,000, like 300,000. And then for key soap, we are going to produce 8,000, right? And 8 factory, this thing per unit is what? 6. So 6 times 8,000. And we are going to actually get 686 48. Yeah, 18, so 48,000. And when we add the 2, we are going to get 348,000. And that's the total factory cost of it. Now, if we want to compute the maximum profit, then what's going to happen is that we find the throughput profit and then we subtract the factory this thing from it. So the throughput profit. So let's look at maximum the profits. Sorry, my pen is writing slow. That's why I've kept long. Throughput profit minus factory and throughput revenue. Sorry. Or contribution maybe minus total factory cost. So the throughput, this thing is going to be for throughput profit geisha is going to be 17 times the number of units we are going to produce. And then this is giving us 340,000. And then it keeps up. It's going to be 8 times, and you are going to get 8864 another one. So the total is going to be I'm doing this just to make it comprehensive for you. You can do it in the easy way by just subtracting all the cost from it and then getting the profit straight. Like for example, in this question, you see they've given you the profit per unit here, so you can just multiply the profit per unit by the units they are going to produce, and then you get it straight. But I'm just trying to make it comprehensive. That's why. Okay. So now, as we established up here that throughput revenue minus the factory this thing, where the factory total factory cost is this, and then throughput is this. So let me just name it A, B. Yeah. Right. So A minus B is going to give us. So that is the maximum profit. That is the maximum profit. Right. Now, we said we should find the throughput accounting ratio. Right. Or let me see. Yeah, we actually found the optimum plan, and then we've been also able to find the maximum profit. Now, instead we should calculate the throughput accounting ratio for each product. Now, to do that, remember the throughput accounting ratio, as we established up there, is the return per factory hour over the cost per factory hour, right? So we've solved for the return per factory hour up here. We've solved the throughput per labor hour here. It's still the same as that one. So now let's do the other one, which is the cost per factory hour. So cost per factory hour, as we established earlier, we said that it's the total factory cost all over total bottleneck or total key resource available. All right. So with this, the next step for us to do is to get the total factory cost. And then we've solved for the total factory cost to be here. We had what? Total factory cost to be 348,000. We're bringing the same thing. And this is going to give us 7.25. So we calculated the total factory cost based on the units we are going to produce. But in the slide, there was a slight, I think, error here, right? In the sense that the calculation was based on the total distance, even though they will not be able to produce all, but in the slides, they did all, right? So that's why you have to understand it. If you don't understand it, you maybe do the same thing. All right. All right, so now, since we have this to be 7.25, now let's move on to our throughput accounting ratio. Which is the return per factory hour over the cost per factory hour. And the return per factory hour, I think we had it to be for Geisha. Okay, so oh, so we had it for Geisha, and we have it for key soap. Now, for Geisha, when we computed for the throughput, we had 17, and we divided by the number of hours, and we had 8.5. So 8.5 divided by now the listen with the cost per factory hour we calculated up here was 7.5, 7.25. And this one we had 8 up there, and then divided by 7.25. And then this is going to give us 1.17, and then 1.10. So this is the throughput ratio for this, and then for this. So all of them are above 1.0, so they are profitable, right? All right. So let's go back to the slides, then move on quickly. So it's basically the same thing, but the only thing was just here. So, all right. So the next one is the environmental management accounting and the role of environmental cost in accounting for sustainability. So the environmental management accounting actually entails systems and practices that provide information about environmental impact of business organization, like what the business does and their impact on the environment, right? So it's actually it is actually made up of the financial information and the physical information about the use of flows, energy, and outcomes of energy, water, and material, including waste and etc. So it extends traditional management accounting tools and techniques to include greater sustainability perspective to provide management information in support of sustainability. Now, when we are talking about the environmental management system, what we are just trying to say is that there are systems that organization puts in place to manage the environmental performance. And some of them include we have the environmental performance, we have the social performance, and we have the economic performance. For the environmental performance, it deals with the impacts of an organization's activity on the environment, including natural systems such as land, air, and water, as well as people and the living organism. Then the social one is also thinking about the impact of an organization's activities on society, including the broader community and employees, customers, and suppliers. And then the economic one is also thinking about the impact of an organization's activity on the economy, including financial measures and broader measures of the economic impact. Now, we have under the environmental management accounting, we have the environmental cost. So these are actually the cost an organization incurs to prevent, monitor, and report environmental impacts. It can also include the cost of failing to comply with environmental regulations, right? And these are the tiers we are having here. We have the conventional cost. So for the conventional cost, it is the cost that is actually incurred to run the normal operations of the business. So this can include electricity, water, and then material costs and those kind of stuffs. We also have hidden costs. So hidden costs are like costs that exist but are not obvious in the financial statement. You don't see them in the financial statement. So these are actually include the cost of environmental audits and monitoring and reporting on emissions and stuff. You also have the contingent cost. So the contingent cost here is more or less like a potential future cost that may occur, right? So it includes fines and penalties that maybe if the firm do not comply with the regulations, it might be placed on them. We also have the relationship and image cost. So this one is similar to impairment in the sense that your goodwill will actually be depreciated in terms of you, let's say, uh, doing bad stuff on the environment, like causing environmental degradation and stuff. Then we also have the societal costs. The societal costs are like costs that are imposed on society, right? And it's more or less like pollution, right? That will actually cause health problems and stuff. Right. Now let's move to transfer pricing. So transfer pricing can include the transfer of goods, for example, goods within an organization, right, from one department to the other. Maya and the like, right? So now they actually do that to provide information that motivates divisional managers to make good economic decisions. And it's also to provide information that is useful for evaluating the managerial and economic performance of a division. It is also used to intentionally move profit between divisions or locations because you're moving price. And then it's also to ensure that divisional autonomy is not undermined. So these are the main transfer pricing methods. We have the market-based transfer pricing method, right? So for this one, what it means is that the goods or services will be transferred based on the market price, right, from one department to the other. Whilst here, we'll also transfer goods based on the marginal cost. We only think about the variable cost of production. That's what is going to be transferred. And then the other part here is the full cost, the total cost. They are going to transfer based on the total cost of producing that good. And then here is also the cost plus transfer markup. So here, the full cost, then they will add some profit that they are expecting to get on it. And here, we also have what? A negotiated price. So here, they are going to negotiate with the other departments that this maybe I want to give it to you at this. This one say no, no, no. Let me also give it to you at this, and the likes, right? Huh. So I've spent quite long on this session. I hope you understand everything, right? If you don't understand anything, you can drop a comment and then I'll deal with it. Thank you so much for your time, and I'll see you in the solving part videos. See you some other time. Bye. I'm hearing that some people say they want to do donations for me. If you want to do donation, if you want to donate for me, you can do it here. 02472449 595. The name is Raquel. Name is Raquel Kofi. Okay. Oh, this pen you can military. Yeah. The Raquel will have C here. Right. Yeah. So if you want to do donation, because this is our final semester, want to do donation, you can send it to this number for me. And you send it, please use your number as reference so that I'll call you and thank you. All right, see you in the next video. Bye.